Welcome to the Lone Star Capital Podcast. I'm Rob Beardsley, founder and principal.
And I'm Craig McGrouther, Director of Business Development.
On this show, we talk about real estate investing, business,
and so much more.
Hello and welcome back to another episode of the Lone Star Capital Podcast. I'm your host, Craig McGrouther here, alongside the founder and CEO of Lone Star Capital. Before we get into the show, we're going to talk about something that you've heard once before and you're going to hear 1,000 times more, which is we have our Lone Star Capital Summit coming up here in New York City on September 14th and 15th in Manhattan. The pre-party will be at the Carnegie Club. It's going to be awesome. It truly is quite a spectacle there. It's exactly what you think a nice old school classic New York room will look like. It's going to be great there. And then next day, we'll have a full day affair on Monday, September 15th in the One World Trade Center at our incredible venue space, having 360 panoramic views of the city. You've got an unobstructed view of the Statue of Liberty, some water, and a whole lot more. We're absolutely elated with doing the conference. We were almost thinking about not doing it last year, but thank God we elected to actually do it. In fact, thank you so much that we actually were able to do it, and I was able to convince you because the turnout and the sign-up rate has been incredible so far. And there's a reason why. We created a really great product. It's no secret that the bulk of the conference is about connecting and meeting with one another and networking there, if you will, and that's structured throughout the way. And that's why I believe people are coming back time and time again, because they come, they apply, or they get invited to come. We know what they're looking for. We know what they're seeking. We know who they are, and we pair them with someone who could be a benefit to them. And that's the beauty and the value of what you're paying for to come to our conference. So if you want to learn more about it, go to our website. Rob, where can they find it?
lscsummit.com.
Excellent. Awesome. Getting into the show now. So funny enough, it's no secret that Austin is going through a lot of issues. We actually, though, were just in Austin. I can't lie. I loved it there. I see the appeal for sure. We had an incredible fund manager summit there, which if you were not there, we were bummed to miss you. It was awesome. I mean, gosh, that was a cool event.
One of the best corporate events ever.
Do we have the video published or on our website where we can do a little screen sharing for those who are watching?
Let me check.
This is a very good digression to start the show here. But just for those who don't know, we hosted an event with our friends at Aspen Funds. It was a full day affair at a gun range called The Range. It was a country club, to say the least. It was incredible. The scenery was amazing. We all got to shoot some guns together, learn. Many people who are our friends that are Californians as well, who'd never shot them before, had the experience to do that with the sheriff, Sam Morris, showing them how to do it, making everyone feel comfortable. There was an incredible educational session as to how the guns work, stuff like that, and then masterminding on very, very incredible topics that are gonna, help kickstart people's businesses regarding capital raising, best in practice relations, underwriting, marketing, going through people's websites, referrals, and paid ads. So people literally walking out of that conference, that little mastermind, are like, I learned more in a half day or 3/4 of a day here than I did in 3 or 4 day events. So that just speaks to how awesome that was.
Most of those sessions are actually
That's right.
They're on our on our YouTube, so you can actually watch those full 45-minute long sessions on those topics where we were sharing kind of with our inner circle. So we made it public. I think that's super cool. But
yes, Austin's great. Unfortunately for Austin, it is probably the worst multifamily environment in the entire country, and there's more headwinds coming that way. But for those who are not privy to this and haven't listened to this show, they might be shocked to find out that, in fact, Austin has got about 15% of supply coming online, which, quite frankly, is just not really a digestible number in the short term in regard to really multifamily dynamics. To make matters worse there, it seems as if the luster, the allure, is unfortunately also going away with one of the biggest industries there, which is tech. So it looks like Austin lost his tech sector. Austin lost tech sector swagger. So it looks like tech talent is fleeing Austin, Texas as quickly as it arrived. 5 years ago, Austin attracted Californian companies with promise of lower taxes and a better quality of life. But it shows last year, big tech employers in Austin dipped 1.6%, making startup employment fell off 4.9%, yada, yada. But essentially, it sounds like the Austin setup there, if you will, of tech is, retreating or receding a bit. And Austin's a weird market. Austin has kind of cap rates, capitalization rates, a metric that we look at as kind of an apples to apples comparison to size up deals, if you will, through different markets. Austin has cap rates that are, mirror and matching what you'll see in California, in the Silicon Valley, in Los Angeles, and kind of gateway markets, but it's in Texas, which is challenging. So the fundamentals are really rough right there. And then seeing employment maybe getting a little bit soft here and stymied is not what you like to see if you're an Austin person. So we'd love to hear your thoughts on this, Rob.
I think there's two thoughts here. One is, I think this is a little overblown. It's kind of like, oh, everything's great or everything's bad. And so I feel like this is where, like, the market is controlled by fear and greed. Right now it's kind of fear. It's like, oh, well, all the tech jobs are leaving Austin and they're never coming back, and Austin is done forever as a tech hub. And on that basis, I mean, it's probably a great time to invest in Austin, because it's simply not true. Austin's not going to go away as a tech hub. It's going to be just fine. Has it taken a hit? Has it lost some of its swagger? Yeah, sure. But you know what? This is just payback for the coast, right? Because where are the jobs increasing? The jobs are increasing in San Francisco and New York, right? Specifically, when we're talking about the tech jobs are leaving Austin and other Sunbelt cities. Sorry, we're not talking our book today. And they're going to San Francisco and New York. And why am I saying this is payback? Well, because a few years ago, right, you had COVID and you had the death of the city. You had
Austin was the belle of the ball. Texas was the belle of the ball. Florida was the belle of the ball.
Remote work, office is dead, cities are dead. So people said, okay, all the tech companies, Silicon Valley has lost its monopoly on tech employment, and therefore it's lost its appeal and it's dead. And New York City is closed and offices are closed and New York is dead, right? And so those were the great times to invest in San Francisco and New York.
Of course.
And so now they're on the upswing and Austin is languishing, and it's dealing with supply and it's dealing with tech jobs leaving. So this is cyclical in my opinion. I don't think it's secular. I think the awesome fundamentals that have made Austin one of the fastest growing cities in the country for like 30 years now, it's just going to keep on growing. Austin has, like you saw it, you could smell it in the city. It's got culture, it's got excitement. People,
je ne sais quoi.
Je ne sais quoi. Yeah, people like Austin. They want to be there. And if people want to be there, then employers will come and set up shop so that they can take advantage of talent that is there. Is Austin, New York or San Francisco? In my opinion, no. It's definitely not quite. But that doesn't mean that it can't be a very, very strong city and therefore a good place to invest in multifamily. So, yeah, that's kind of my opinion, I guess.
It's going to be funny in 10 years from now, 20 years from now, we're going to be looking at all these incredible value add 2023, 2022, 2023, 2024, 2025 vintage properties, whether it be in Austin, Houston, Dallas, Phoenix, whatever XYZ market we're going to be in, because the building craze has been so crazy right now that everyone's obviously churning through as we speak. So it'll be interesting as we plan to be in this business indefinitely. The cycles of things where it's like, oh my gosh, 60s, 70s deal. Clearly that's positioning for a redevelopment, right? So it's going to be an interesting thing to watch as time goes on and to kind of track Austin. Naturally, we would like to be in Austin. We probably will get to Austin at some point, but it's very, very interesting fundamentals in that market for sure.
You're always chasing in Austin. It's just the numbers are just out of reach because there's no secret about Austin, and there's just so much demand. There's so much money that wants to be there. It's so competitive. So what's been interesting, and this is a lesson that I've learned through this most recent cycle, is that just because rents come down and income is down and cap rates are up and therefore values are way down, doesn't mean you can actually take advantage of the opportunity. Like Austin, rents are way down, concessions are up, there's a ton of supply, cap rates have expanded, but you can't really buy anything. So because people don't want to sell and take a huge loss. So
no one's rushing to lose money. It doesn't factor.
Yeah, no one's selling to lose money unless they have to, which is very different than the stock market, because in the stock market crashes, guess what? You can buy and sell that very second, and you can
Yeah,
get that price.
everyone thinks they're going to be Gordon Gekko or Mark Baum or whoever it is in XYZ financial movie and going to buy all these properties and distress. It's like, yeah, well, there's someone on the other end who's working just as hard as you are to provide and ideally keep that investment afloat and not lose their investors' dollars to ruin their name. Like
Yeah,
it
so
doesn't. It's just
it,
not that easy.
it's actually more difficult to buy at distressed pricing in the private markets than it is in the public markets. So that's been a lesson that I've learned, and I think everyone has seen that, because the buzzword of 2023 maybe was distress. That was the it word of the
Oh
year.
no, it still is. Like to be honest,
And maybe it still is. Yeah, and people are just, I'm waiting for distress. I'm waiting for distress.
but at what cost, right?
I'm going to buy super cheap. And guess what? It just hasn't happened because sellers have been reticent to sell. And so that's limited the supply of deals in the market. Meanwhile, there's still plenty of buyers in the market. So the supply demand, as far as buying and selling, has stayed quite healthy, which has put a floor on prices. The same is not true for the public markets. So next time when, the world crashes and the stock market tanks, that's the time to take advantage of buying, rather than saying, oh, now's my time to be a distressed real estate investor and I'm going to go buy up all these cheap deals, because no one's going to sell it to you. And unfortunately, everything's not as easy as it sounds, because in the public equities, you've got to fight your emotions. And those are very, very difficult to buy when things are crashing, because as they say, when it's time to buy, you won't want to.
Exactly. So happy we discussed that. Let's get on to the James Ang breakdown. Uh, One of the best podcasters in the biz. We love his information. I always screenshot it. Sorry, James, I do not email you for the slides. Maybe someday I will. But that said, let's get into it. Just the notes. I had some screenshots here. DFW transactions 2025 year to date. Doesn't look like there's many deals, but what I kind of wanted to zoom on here and double click was just property sold count. Though this is discretionary, right here at 10 properties. This is upper mid range 15, lower mid range 19, workforce 8, affordable 4. Kind of interesting to see that it looks like in that kind of C class, C product or affordable, nothing is really trading. I mean, this is a very insignificant amount of properties for workforce in that range. There only 8 trades so far this year in the DFW area. Very few affordable properties, fully affordable, only 4, very few. And in totality, 56 properties have sold with the average sales price about 36 million and about $160,000 per unit here. So as we look at that information, what's kind of your takeaway there?
Yeah, it's staggering. I mean, the property counts is one thing, but if you just look at the volume, dollar volume, it's even more staggering, because those 8 workforce housing deals that have traded is 900 units. And
That's
I mean,
nothing.
this can't be right. It's $12 million in sale, average sale price,
Yeah.
$12 million. Okay, that makes more sense.
Yeah. And the average is at 36 million per the property, basically rounded up to 37 million.
Yeah, but still,
Well, that
yeah, it
explains
just
why we haven't bought anything, because if the average is there, our criteria is a skosh higher than that.
well, but also that's not where the trading is happening. That's the
Yeah.
average, but that's not the median. If you look at the upper mid range or the low mid range where we buy,
It's
it's
50, which is on
50,
point. Yeah.
31. So I mean, it makes more sense. And also, there's quite a lot of transaction activity in that space. So
Well, that's where it's been most fluid, which we've seen throughout the market. Actually, is that B and C, as we've been mentioning, you've been listening to our podcast, you would know that there's really no market there, and there's more of a market for the newer product, whether it be merchant builds or 2000s or newer, 95 or newer. Those have kind of been the sweet spots. Why? Well, because that's not really what a syndicator would typically buy, folks like us, although we'd like to think we're at the higher level of it. That's really more the institutional players are playing at and buying and what they're seeking. So that goes right in line with what we've kind of been seeing, what we've been thinking, hearing, and kind of analyzed.
yeah, so that's absolutely right. And eventually, the workforce housing deals, the older property, the less quality located properties, the Class B and C deals, they eventually will trade. And that's not going to be a good thing for values, because for various reasons, which we can get into, there's going to be a lot of Class B and C deals that will eventually sell, because they've just held off selling for a long time now. and then they're going to all start selling, maybe not all at once, but it's going to be a deluge, and it's going to cause a lot of sellers to hit the market, and there's only going to be a certain amount of buyers, right? It's not like buyers are going to magically match and come out of nowhere. So there's a set amount of buyers, but then way more sellers are going to come into the market, and that's going to necessitate a decrease in prices because buyers are going to have their pick. So that is on the way, I think. And maybe that decrease in prices just means a lack of increase while the rest of the market is increasing. But what we've seen is the Class A space has already appreciated. The Class B and C space, especially like B minus, and below, has depreciated or stayed flat. And it probably is just going to continue to kind of hold there, especially once more properties do hit the market.
Next thought, I had to put this note in there. 1001 Ross traded officially. For those who may or may not recall, 1001 Ross was a deal that we had fully raised and lined up in Dallas. It's kind of in the downtown area there, if you will, very close to where the Goldman Sachs building was. But it was the deal that never was. Unfortunately, that deal had treasuries blow out 75 plus basis points during the equity raising process, making the deal stretch too thin for it to make sense for us. And sadly, we had to walk away from a very hefty, non-refundable earnest money deposit placed on that deal. But it's all about doing a deal, the right deal, where we think we can make sure that our investors, of course, the people who employ us, if you will, have a good deal. And just because we can raise for an opportunity does not mean that we're going to transact on that deal should we get new information. New information can change all the time, whether it be, switching to a floating rate debt structure, whether it be, thinking that the market has changed. Some dynamic has gone on, and unfortunately, that deal became non-transactable during the process there, and we had to walk away. It was a very big disappointment, but ultimately, I think it was the best thing that we've done as a company, and really just reassured me that I was in the right place when that occurred, that we had the ethics to walk away and to do right by our team, and do right by, most importantly, our investors, to make sure that they know that they're at the forefront of our thinking and decision making. And ultimately, you got to post your results. It's like golf. You got to post your score at the end of the round. You got to make sure that you are ethical there, if you will. And we didn't want to do a deal just to clip fees and grow our Dallas expansion. It's really got to be the cream of the crop for us to feel comfortable to move forward with an opportunity. And unfortunately, it wasn't so on that one. But I just wanted to mention this deal because obviously we have some history with that. And that deal did, in fact, trade nearly 2 years after we got that deal awarded to us and move forward. Walker Dunlop saw transaction volume improve in 24 into the first quarter of this year, and there has been a growing sense that the pent-up demand for financing needs to be deployed or capital recycled is going to push into 2025 higher volumes. Private capital providers are becoming more attractive, with Q1 being the highest CMBS origination quarter since prior to the Great Financial Crisis. So just wanted to know your kind of takes on this slide here, Rob, with Walker Dunlop financing update.
Well, yeah, I don't really remember this part of the report, but I mean, it's very impressive. Walker and Dunlop is an agency lender, Fannie and Freddie. They don't do any bridge, I don't think. So they just have a super healthy portfolio. They have 3,200 loans, only 8 are in default. It's really incredible. So it shows you the stability of well-financed real estate, especially if it's in a good location. It's really, really good. You might not, 10x your money in 10 years,
Yeah.
like that deal that we saw pitched today in our email. That's just insane, but that's a different thing completely. But this is very stable stuff, as you can see in their loan book. 17 basis points of loans that are at risk, so of default there. So that's very impressive. Don't really have any other feedback or commentary. They talking about the 10-year treasury yield and talking about how, like us and everybody else, we're all sitting around waiting for treasuries to come down to where we can finally buy, where we can finally sell, where we can finally refi. And that day it's not coming, right? People are waiting. Oh, it's right around the corner. It's going to come. and rates have stayed stubbornly high. And it's just been very difficult because the market right now is not set up in such a way to where it's like, oh yeah, it's a no-brainer. It's easy to deal with these higher rates. The market has actually adjusted for lower rates. And so pricing has adjusted for lower rates, and everyone's waiting for rates to catch up. And what this earnings report discussed is basically that a lot of people are getting to the point where they've been waiting around and their time is up. And they're saying, you know what, I've been waiting for treasuries to come down to the mid threes, but it hasn't happened. Treasuries are in the mid fours. I'm just gonna go for it and deal with the consequences. And I'm gonna do that sale. I'm gonna do that purchase. I'm gonna do that refi. So that's kind of, we're seeing that anecdotally as well.
Yeah, no, I think the biggest thing as I looked through this, I also was like, wait, where was I going with this? But then I actually recall it's the final paragraph of this if you're watching the podcast. And if you're not, I'll read it. But the underlining theme is this: commercial real estate owner operators have ran out of time on delaying refinances, delaying the return of capital, and delayed the deployment of new capital. As a result of that, the clock is ticking. They're now saying, look, I may or not love a 4.7 10-year. That would be nice if it was 4.7 today, 10-year. But I need to go and sell that asset to return capital. I need to go buy that asset to deploy capital, or I need to refinance that asset because I've got 2-year, 1-year extensions, and now is the time to go get permanent financing put out on the asset. And we were very clearly seeing that drives volumes. So that was kind of the theme there. That hey, this has been a very, very kind of bizarre point of the market cycle, a different cycle to say the least, which is actually the perfect segue into the Arbor comment, which I thought was the most important note. Obviously, everything is relative to, I would say, your experience level within getting to an industry. We will not pretend like we are the market cycle people on our team. That is what our new friend Sam Morris, our new partner of the team, provides for sure. We can read, we can educate ourselves, we can ask our parents questions, and our mentors like Alan Steinberg and Chris Mendez, and the incredible mentors like Ilya Gamers of the world, what market cycles have felt like, things of that nature. But until you go through it and actually do it, things are in fact different, or of course the Jeremy Rolls of the world, if you will. But Arbor, obviously a very known bridge multifamily lender. I believe they only specialize in bridge. Rob, do they do any other financing, or are they mostly known for bridge? Can you kind of explain to the audience potentially what they are niched down in, or what their business is per se?
Yeah, similar to Walker and Dunlop, they do Fannie and Freddie debt, but different from Walker and Dunlop, they have a CLO bridge program where they originate bridge loans basically for deals that are not ready for one reason or another, occupancy or income. They're not ready for a permanent stabilized loan, so they need a bridge loan to get around those underwriting constraints. And then the way that Arbor does that is they actually package those loans up in a collateralized loan obligation and then sell off those uh, bonds essentially into the market. So that's how they're able to get their financing for the bridge loans. But yeah, Arbor is a large kind of major player for the multifamily financing market.
Yeah. So the point I want to make here, and the comment I want to really call out here, is the following. Most of the time, the cycle goes for 18 months, 20 months, 16 months, and you recover. This has been over 36 months and still going. There has been bits of recovery, bits of setback. So that's very interesting. And also calls out they've been through 5 cycles going through here. So these are not people who willy-nilly just got into the market, and they're basically saying this is taking almost double the length to recover as to what a normal cycle looks like, which is very fascinating to think. So it's a lot longer of a cycle than most people are accustomed to, but we're starting to see some elements of recovery. We're starting to see better occupancies and better growth and things of that nature, but there's still a lot to learn from every cycle. They still are anticipating things to be a little bit difficult for the next, call it till really 2026 or so. So that's why we say it's not survived to 25. It's probably till 2027, and there could be a new set of issues as that occurs then nonetheless. But definitely a very interesting time of the cycle indeed. Did you have anything else you wanted to call out here? Any comments, Rob, that you wanted to speak on as we have this kind of detail up there?
No, you nailed it.
Yeah. super interesting. As I said, we've never gone through this as we're, I'm a baby-faced 30-year-old. Rob is obviously a skosh younger than myself here. But it's just very interesting to go through one of these ourselves and to really feel it. I mean, as I recall, getting into this business summer of 22, little did I know that we'd have essentially almost 3 years now of, continuous decline and negative sentiment. And obviously, negative decline, it takes some times for, things to get worked out. Things are still getting worked out. As you saw the slide before, people need to really kind of, or get off the pot here, if you will. They need to make decisions. They need to, post. They need to transact here, either sell it, deploy capital, do something. There's so much idle capital sitting on the sideline. Now you got deals getting scarcity premiums, meaning basically, hey, since there's so few deals on the market, we're willing to pay a silly price just to get some, capital working for us because they don't get paid to look at it. So it's just a very interesting dynamic in the marketplace, all in all. There's not this obvious sky is falling, and you could argue that happened in 2024, where we did some of maybe arguably the best deals we did in our company cycle to this point. Obviously, we don't know what this year will hold for us so far, but we feel very comfortable with 24 and kind of taking advantage of the scarcity and the kind of the sadness, or I guess the depression of the market then. Going over to Canden, what they're seeing here, new supply has peaked in our markets and apartment absorption continues to be strong. In fact, new starts are at a 13-year low and are down 80% in Austin and between 60 to 80% in Houston, Denver, Charlotte, Raleigh, Atlanta, Nashville, Washington, D.C. Rent affordability continues to be a tailwind, which wage growth outpacing rent growth by over 300 basis points from the past 28 months. The premium to own versus rent continues to be historically high levels, making apartment homes more affordable. That is something that's positive there.
Yes, this is very positive. The fundamentals are very positive. Supply is being delivered, but then once it's delivered, there's going to be actually a dearth of supply. That's going to be beneficial. There's, unfortunately, homeownership is getting more and more unattainable, or maybe it just kind of is where it's at, and maybe it's just going to kind of hang out here. Maybe it'll continue to get more unattainable or not. Either way, it's really keeping a lot of people in the renter pool for longer, which is just increasing the aggregate demand for multifamily. So that's why we are sooner or later going to see rent growth above inflation. So that's very good for our industry. And then similarly, wage growth outpacing rent growth, at some point that rent growth has to catch up, right? So if people are making more money, rents are going to go up. It's just a matter of time after concessions burn off and there's not as much supply and competition. So that's all these reasons are why multifamily is as competitive and expensive as it is right now, even in the face of poor fundamentals today and high supply today. People are looking beyond today and they're looking at the future, and they're very excited about performance later. So that's frustrating.
And in that theme, sorry to cut you off, the bottom thing here that Canden Multifamily Market breaks down says, in terms of how we're underwriting today, we're underwriting with the view that rents are going to be flat-ish for this year, and then you're going to start to rise next year at probably better than normal rates. And then within 27, 28, we're going to have outsized revenue growth. So this is why when we do our underwriting models, we do kind of a flat 3% growth that's compounding, because we might be flat this year, we might be at 3% next year, and then we might get an 8%, right? Which could kind of create that 3% compounding return over that 5-year hold period. You just don't know, but we're kind of seeing that with supply kind of slowing down, with affordability being kind of an issue, that apartments, especially considering where wages are growing. I mean, Harris County wage increases were just shy of 7% in 2024. That's awesome, right? That's obviously drastically outpacing what rent growth has been. And then final slide here, I believe, yes, indeed, is just Canden Operations. Rental rates for the first quarter have effectively new leases down 3.1% and renewals up 3.3% for a blended rate of negative 0.1%. Renewal offers for May, June, and July were sent out with an average increase of 4.2%.
It's really good.
Turnover rates across the portfolio remained very low, and for our first quarter 2025 annualized net turnover rate of 31% was one of the lowest in our company's history. We attribute this in part to continued low level of move outs for home purchases, which were 10.4% this quarter. And we are assuming that insurance for us, 25 is going to be a flat number, which is awesome. Expense ratios. Okay. These are great things here. These are positive tailwinds. So these are the signs that now is a good time to get into this space, folks. Like, this is a great time. These are great stats, awesome information to tool yourself, to arm yourself. If you're a fund manager, this is the information you need to be providing your investors. If you're a retail, if you're an LP investor and you're seeing stuff like this is the time to get into smart deals right now with good people, with good sponsors.
Yeah, impressive stuff here. I mean, our insurance is going to actually be a big decrease this year, so I'm not sure why theirs is flat. They probably have they're very big.
Well, it
So
depends what location they're in, right?
Sure, but they probably have a captive, so their captive is just flat. They just had a normal year, so it's normal. But we have a master program, which is influenced by the London markets and et cetera, et cetera. So we're actually going to see a huge decrease in our insurance costs come our May 31 renewal, which is going to be pretty much happening as we speak. And that's it's exciting stuff.
Yeah, these are just positive fundamentals, positive things that we're thrilled to see on our end. It's obviously a grind, especially when sentiment isn't the most positive and all you hear is some negative stuff. But really happy went through that. And obviously we invite everyone to watch James Ang's monthly webinars. He puts out great information. We just want to react to it and talk our books and explain maybe a little bit more in depth as to what this means to you, the investor, or you, the fund manager. And now you can kind of arm yourself like we do for conversations when we speak to some of our people. I do want to make a final point actually and comment here before we wrap up. So I actually received several emails over the last couple of weeks actually pertaining to some changes, and we're not going to go into it too much, but just in regard to the tax exemption stuff within Texas. So just for those who may or may not know this, we have worked with the Houston Housing Authority with every single deal we've done our tax exemption on. We're one of their awesome partners. We really do value the relationship there, and we're doing it through Harris County and the HHA there. So we're not doing some of the stuff that's kind of getting scrutinized, if you will, in reference to a lot of the literature out there online and a lot of potential kind of issues on the tax exemption deals. But we, as I said, we've done that, the correct way through the city. So there's no threat of that getting repealed.
Well, I don't want to say there's no threat, but that, you never know. You want to speak like an attorney, but
right.
Basically the news that you're alluding to is that there's been a bill that has passed both the House and the Senate in Texas that is going to revoke all interjurisdictional housing finance corporation tax exemptions. And so what that means is if you entered into a tax exemption program in Dallas, but you did it in partnership with a housing authority that is based somewhere else, not a local. Yeah, exactly. Not a local Dallas housing authority. That tax exemption will be revoked on January 1st, 2027, assuming this bill becomes law. It's been passed with an overwhelming majority in the Senate, and it's now on the governor's desk for signature. So that's going to create a lot of chaos, to put it mildly, in Texas, because a lot of people went to this program in this way, this interjurisdictional, or known as also traveling HFC structure, as a way to abate taxes and as a way to increase the income of their property in order to fight off higher inflation, higher property taxes directly, and higher interest rates. So with that in mind, if people are going to see their tax exempt status revoked, that's going to then put pressure on their cash flow, because they likely were using the abated taxes as a way to keep up debt payments or to refinance into a new debt structure, which now will have to be unwound. And so oftentimes a lender would underwrite these tax exempt structures, and they would require the owner or the sponsor to make a personal guarantee that if the taxes were ever to be revoked, they would personally guarantee the pay down of the loan to get the loan back into balance at an appropriate debt service coverage ratio. So you're going to see come 2027, when these tax exemptions are revoked, and even in 2026, as people are going to start getting ahead of this date, this drop dead date, there's going to be a ton of refis. There's going to be massive capital calls. People are going to be capital calling to do cash in refis so that they can get into better debt structures and unwind these effectively broken affordable housing partnerships. Or they're going to simply sell in 2027. They're going to use up all their tax exemption that they can get through the end of 26. And then in 2027, they're just going to look to sell, and they'll probably have to take a loss, but they'll have to sell in order to get capital to pay back the lender, because otherwise there's really no way to pay off the lender there. So it's going to be a shakeup, and it's actually going to be very interesting because I think it will present perhaps buying opportunities in 2027 when people start to sell these assets that are unwinding out of this program.
Yeah, well, thank you for the more elegant stating of the state of that there. Just wanted to address it because I did get several emails asking how our properties are. But as I mentioned, we've done it the appropriate way, working directly with great people there to not kind of create future friction down the line there. So that about wraps it up. Rob, do you have any closing thoughts here?
Nope.
Awesome. Once more, buy the tickets to the summit or apply to the summit. We appreciate you listening, and we'll see you next week.